Hey, welcome back everyone. In this video we are talking about calculating break-even premium payments. Now this is one of the most confusing and perhaps lengthy question on the FRM part 1, but I'm going to explain this concept in the most logical manner. Now this is a high probability question on the exam, so if you do see this, make sure that your concepts are clear so that you are able to solve it. Alright, so before we get into it, make sure that if you haven't subscribed to our YouTube channel, make sure that you go ahead and subscribe it. Alright, let's start with some basics. So let's say that Mr. X purchases term insurance policy for 10 years. The premium that he'll pay per annum is $15,000 and the policy amount is $500,000. So this essentially means that anything happens during this duration, right from day 0 till the year 10, if anything happens in this term insurance policy to Mr. X, let's say that Mr. X dies during this 10-year duration, then the insurance company will go ahead and they'll pay out this $500,000 to the nominee of Mr. X. Okay, but will this company do this for free? No, right? They'll charge something, and in the insurance terminology we call this as premium. So premium is the money that the customer will pay to buy this insurance policy. Alright, so every year Mr. X will pay $15,000 to continue with this policy. Alright, so I've taken a hypothetical example right here, and as you can see, Mr. X buys this insurance policy at day 0 and he pays the very first premium at the beginning. Now in this specific example, we have assumed that Mr. X survives this 1 year duration, and then by the end of 1 year he makes the second premium of $15,000 to the insurance company. Then again he survives this second year duration as well, and by the end of the second year he makes the third payment. So on and so forth, he keeps making the payment. And now let's just assume that between this 6 and 7 years Mr. X dies at this point during the middle of 6 and 7 years. So as per the policy, the insurance company will make the actual payout of $500,000 to the nominee of Mr. X. Clear? So this is a typical insurance structure, but there's also something known as expected payout that the insurance company, before making this actual payout, they want to understand what is the probability of a person dying during this 1 year. They want to have a probability based cost. Alright, so this expected payout that you see here, it's nothing but the probability based cost of a person dying. All these things are basically the unrealized cost to the insurance company. This is the actual cost, but all these are something that is not realized. Okay, now the question is, how do we calculate this expected payout? Consider this situation: only if the person dies, then only the actual payout will trigger, right? So I can say that the expected payout is also dependent upon the probability of a person dying, right? So we have a formula for that, and the formula is probability of death in year 1 multiplied by the policy amount. So the policy amount in our example is $500,000. Okay, so for the second year we have this probability of death in year 2 multiplied by the policy amount. For the third year we have probability of death in year 3 multiplied by the policy amount. So on and so forth, they will calculate their expected payout. Now where do we get these all probabilities? Well, there is something known as mortality table, which the insurance companies use a lot to find these probabilities. So I'm going to show you that mortality table in the next slide, but now I want you to understand one thing, and this is very important. See, the probability of death in year 1 is something we can find from the mortality table. Alright, but this probability of death in year 2, okay, this is a conditional probability. Now what do I mean by that? The probability of death in year 2 is conditional on the person surviving in the year 1. Let me explain this. So let's say that we find this probability from the mortality table. Then once we move to the second year, we are assuming that the person has survived here, right, during this first year. So the probability of death in year 2 is equal to the person has survived in year 1 multiplied by the probability of death in year 2. Now this is something that you find from the mortality table. So hopefully you are clear. Now let's say that if you want to calculate the probability of death in year 3, okay, the probability of death in year 3, then we have to assume that the person has survived in the first year as well as in the second year, right? So we need the probability of survival in the first year multiplied by the probability of survival in the second year, and then we have this probability of death in year 3, this unconditional probability from the mortality table. Make sense? So on and so forth, we can go ahead and we can find all these things. Now the question is, how do we calculate this probability of survival? This is very easy. See, if I tell you that if the probability of a person dying during this 1 year duration is, let's say, 10%, then the probability of a person surviving would be 90%, right? Similarly, if I say that the probability of a person dying in second year is, let's say, 11%, then the probability of survival would be 89%. Simple. So what we are doing is that we are given this probability of death in year 1 from the mortality table. We just subtract 1 minus this probability of death in year 1, and we will have our answer as the probability of survival in year 1. So hopefully you are clear with this. And now let's talk about the break-even premium. This is the question that we are making this video for. So break-even premium, now what exactly is this? This is the premium wherein we match the cost. This expected payout is the cost to the insurance company, and the premium is something that the insurance company receives, right? So we are matching this cost to this premium, and that is known as the break-even premium. So it is present value of all the expected payout. We take a present value to day 0 and present value of all the premium payments. So we take the present value of all this premium payments, and we have our answer as the break-even premium. Now one important thing that I want you to be clear of, and that is this premium that you see of $15,000. This is the actual premium that the insurance company charges to the customer. This break-even premium, this is the minimum premium that the insurance company charges. Okay, it's going to be lesser than the actual premium. Okay, this break-even, as we have in business, like there's no profit, there's no loss, right? So that's the break-even. So this break-even premium is on the same concept. We are matching the expected payout, which is all these expected cost, to the expected income, which is premium, right? So that's what we are doing right here. Now the good thing is that you don't need to calculate for so longer periods. On the exam you will have just maybe maximum 2 periods to calculate the break-even premium. So break-even premium, and in a nutshell, let me explain it. We have the expected payout, which is the probability based cost. We assume that this payout will happen at this center in the middle of the year. So we take the present value till today of these expected payout. That's it. That's what we do to find the expected cost. We've got the probability of death in year 1 multiplied by the policy amount, and we have got this conditional probability in year 2 multiplied by the policy amount. We calculate this, we just take the present value, and we've got the cost, present value of the expected payout, and we have to make sure that that is equal to the present value of premium payments. Now on this example, we knew that the premium is this, right? But when we're calculating the break-even premium, we don't know what this premium is, especially the break-even premium, which matches the cost to the premium. We call this as Y. Alright, and this is something already at present day because the premium is received at the beginning of the period. So the insurance company will receive this premium, and then this premium I can call it as Y, but I also need a probability of survival in year 1 right here, because we are assuming that the person survives this duration and then only he'll be able to make the payment. Right? As I said in the very start, I told you that Mr. X survives this first period, then only he is able to make this premium for the second period, right? So we need the probability of survival in year 1 for this premium of Y to be received. Okay, So this is something that you need to remember. So this probability of survival in year 1 is the same that we calculated right here. So what do? We take the probability of survival multiplied by y, and since this premium is received in year 1, we take the present value to day 0. Simple. Let's take a formal example to understand this. Alright, so this is the mortality table that we have. Now this is something that will be either provided to you by GARP, or on the exam you will have these probabilities, so you don't have to memorize it. Now notice on this table we have the probability of death within 1 year for the male and for the female, and if you see that in the very first column we have the age, and as the age of a person increases, the probability of death within 1 year increases at the same time, while the survival probability, it decreases. Okay, now for the calculation of break-even premium, we just need the probability of death within 1 year. You will not require these things right here. So here is the example. The relevant interest rate for insurance is 3% per annum. Semi-annual compounding would apply, and all premiums are paid annually at the beginning of the year. A $500,000 term insurance contract is being proposed for a 60-year-old male, assuming that the payouts occur halfway throughout the year. Now this is one assumption that we are using, that the payouts would occur halfway throughout the year. Calculate the insurance company's break-even premium for 2-year term. So basically we just need to calculate the break-even premium, also known as the minimum premium, which is the present value of all the expected payout for 2 years, and that should be equal to the present value of the premium payments. Okay, so here I've calculated the expected payout for the 2-year term. Now this is 1 year and this is the 2nd year. I've taken these 4 periods because we have said that the payouts occur halfway throughout the year. So this is where the expected payout would occur. So let's first calculate the expected payout for year 1, which is the probability of death for year 1 multiplied by the policy amount. So let's find this probability of death for this year 1 from the mortality table. So here we have the probability of a 60-year-old male and the probability of death within 1 year. So this is the probability of death in year 1 from the mortality table. We've got the policy amount, which is $500,000 right here. So we get this as the answer. Now this is expected payout at this point, and as I said, to calculate the break-even premium we need the present value of expected payout. So we just take the present value at day 0. So we're taking the present value of this payment divided by 1.015. Now this discount rate is this 3% right here, but we are taking as semi-annual. All right, so we need to discount this for 1 period, and we get this as the final present value. Now for the 2nd year, all right, we have this conditional probability of year 2 multiplied by the policy amount. Now as I told you, this conditional probability is dependent upon the person surviving in this 1st year multiplied by this probability of death in year 2. This is something we find from the mortality table, and this probability of survival in year 1 is 1 minus probability of death in year 1. So here I have already calculated that the probability of survival in year 1 is 1 minus this probability of death in year 1, and we get this as the probability of survival. So the conditional probability of death in year 2 would be equal to probability of survival in year 1 multiplied by the probability of death in year 2. The probability of death for 2nd year would be right here, which is this. Now this is something that we have got from the mortality table. All right, so we have our probability of death in year 2. We just multiply that with the policy amount, and we get this as the answer. Now this expected payout in year 2 happens in the middle of the 2nd year, which is 3 periods away. So we need to take the present value at day 0. So we do the same. We've got the discount rate. We're discounting it 3 periods away. So we have got this to the power 3, and this is our 2nd present value. So now I'm going to add these 2 present values. So this is the total of all the present value for the 2 years. Okay, now calculating this premium is very simple. All we have is this premium. We call this as Y. Now this is certain to be received when the person takes the policy, but we don't know what this premium amount is, so we call it as Y. And then on the second year, we call this premium as Y again, but this premium is conditional that the person would survive the first year, right? Only if the person survives this first year, then only we will receive this premium. So it is conditional on the person surviving in the first year. So we have the probability of survival in year 1. Now this is something we have already calculated right here. We don't need to calculate it again. And we know from the mortality table that at time 0, the survival probability is always 1. Okay, so let's just solve this thing, and we need to discount this premium back to today, right? Because we want the present value of the premium payments as well, and this is 2 period away from today, so to the power 2. And once we solve this thing, we get this as the answer. So the present value of expected payout we have already calculated as, so I'll write the present value of the premium payments now. Alright, so this is something that we need to solve. Now once we solve for this Y, so this is the break-even premium that we wanted to calculate. So that's it, guys. Thank you so much for being with us. And if you haven't subscribed to our YouTube channel, make sure that you subscribe it. Thank you for your time once again.